Financially raw, real, authentic wisdom with Lawrence Oberholzer from Retire Rich and Happy.
Good morning, everyone, and welcome to another episode of Financially Raw. Today, I'm not alone, which is always good. It's great to have a guest in the studio with me, because that means I don't have to prepare everything. I can just come and sit here, give my opinion on things without having to think about it too much. I really enjoy having guests in the studio. So my guest today is Japie Venter, business partner of mine. I've been working together for better part of our lives. So Japie, for those of the people that don't know you, if you can just quickly introduce yourself to them. I know you've been on a few shows with me already, but we never know, people maybe haven't watched those shows. So if you can maybe give people a little bit of background about who you are and what you specialize in.
Hi Lawrence, yes, and thanks for having me back. It's always fun having a chat with you and sharing our knowledge with all the listeners. Little bit of background: I've been involved in the insurance and or financial planning industry for close on 22 years already. It's strange how time flies. It feels like yesterday, but now we're getting old and grey. You and I started Retire Rich and Happy quite some time ago. We worked through all of the hiccups, got everything off the ground, and I specialize in risk. I started my life at Santam with short-term insurance, so I know quite a lot about short-term insurance. Sure. And then from there branched out to long-term insurance, life insurance, disability, all of those types of things. Our focus today I would like to chat a little about short-term insurance, what it is, where it's from, why it's there, and how you can use short-term insurance for yourself. Not necessarily paying cheaper premiums, but making certain that you're actually correctly insured.
Yeah. I think that's the important thing is, yes, you want the best possible cover for what your needs are for the lowest possible premium. Not the cheapest possible premium for the bare bones minimum, hoping that you will be covered if something goes wrong. And I think you're going to help people with that. So just to clarify, short-term insurance, that's your car, your household insurance, those kind of things. So Japie, let's start. Give people an idea of what is short-term insurance and what they need to look at.
Lawrence, I think to talk about short-term insurance, we have to take a step back and firstly understand what exactly is insurance and what's the purpose of insurance. Insurance is a risk mitigating exercise. By having insurance, be it long-term insurance, short-term insurance, it does not negate the fact that something's going to happen. Something is definitely going to happen somewhere along in your life. So the idea is to minimize that risk as much as possible. And here we're referring specifically to a financial risk. So the act of you losing money through something happening. To cover those things, the main two focuses of the financial planning world is long and short-term insurance. Long-term insurance, and I think this is basically the easiest way to understand it. Long-term insurance is any time you're insuring a person and or yourself, your ability to earn an income. Short-term insurance, on the other hand, is any time you're insuring something to a large extent. Yes, it gets a bit more technical than that, but to a large extent, short-term insurance is insuring something. So either your house or your car, or your cell phone or camera, or whatever the case might be.
So just what I was thinking of now is, if people want to put that in perspective, long term, what is the longest thing you will do in your life? You will live. You can't do anything longer than how long you're going to be alive. So that is when you insure something regarding your life, because that's long term. Short term is anything that you will have in your life, because it doesn't matter what you have, anything that you have, you'll only have for a specific period of time, and then it will disappear or get sold or whatever, and that's short-term insurance. Okay.
Correct, totally. So today our focus is going to be on short-term insurance, usually known as your car and household insurance. Now, again, in order to understand short-term insurance, there's a couple of key phrases I feel we should understand. First and foremost would be the concept of new for old. When insuring an item, you can't insure it for the current value that you think, it might be worth this. Because in the event of something happening to that item, which they deem a total loss, so your car being written off, your couch getting stolen, the house burning down, An insurance company cannot replace those items with second-hand or older items. So yes, you have a couch. You bought that couch 10 years ago for 2,000 Rand. When insuring that couch or that TV or that camera, we have to insure it for a value that is similar to a new similar item. And that's where a lot of people struggle with, because they feel, especially of household contents, ach ja, I'll only insure it for 400,000 Rand, because that's roughly what I paid for things 10, 20 years ago.
Yeah. Or what it's worth now. If I had to sell all of my stuff,
Yes.
I'm only going to get 50,000 Rand for it.
So we always have to understand replacement value based on new for old. When an insurance company indemnifies, pays out a claim to you, they are going to replace that item with a new item. That's the first important thing. That brings us to average, which again we spoke about on the last show as well. Average is the principle whereby an insurance company looks at what is the insured value and what is the replacement value of an item which was insured. This ties in specifically with your household contents and your building insurance. So if you insure your household contents for 100,000 Rand, the insurance company comes in after a claim, they do an assessment and they see your household contents should have been insured for 200,000 Rand, they are going to reduce your claim payout. So new for old, average, it's two very, very important factors to understand.
Yeah, and what people don't understand is, and you get so many unhappy clients because of that, is they come, the guy is insured for 150,000 Rand, they steal the TV is only 20,000 Rand, and the guy says, but I'm insured for 150, why don't you pay out my whole 20,000 Rand for my TV? But he should have been insured for 300,000, therefore they're only going to pay out 10,000, not the 20,000.
Correct. And that brings us to that age-old question of, should I use a broker, yes or no?
Yes.
And I don't want to dwell on this subject, but the layman out there does not understand these concepts. And I don't blame them for not understanding. The industry for so many years has tried to keep these things a secret, insider knowledge. And that's why clients sometimes feel that insurance companies are out there to screw them. I had to think of a polite word over there.
Yeah.
So, because they do not understand the basic concepts. Should I make use of a broker? Should I make use of an advisor? Should I get help in planning? Yes, you should. Guys, if you look at the premium difference, 9 out of 10 times, somebody who's in the financial services industry would get you a more competitive premium than you just phoning a direct insurer.
And for me, there's two things there. There's been a mushrooming of direct insurers. People just phoning. Now, the purpose of a direct insurance, and I think the emphasis on price only has become a problem in the short-term insurance industry, because the direct insurers, they're not really focused on making sure you are correctly insured. They are there to try and beat the premium that you're paying at the moment at any cost, because they're not advisors. They are people sitting there in a call center, and their job is to quote as many people as they can and beat as many premiums as they can. And that, I think, there has to be a balance. Like I said in the beginning, it's about getting the correct insurance for the best possible premium, not just get the best possible premium. So this whole thing about save 300 Rand on your car insurance, be very careful of those kind of things.
There's another hidden factor which people seldom understand, and that is the whole concept of an excess. And that again ties in with, oh, I just saved 300 Rand on my premium for my car or for my household contents. Yeah. Excess is what is defined in the financial industry as the portion a client contributes when a loss takes place. So seldom, if ever, will you be insured for 100% of a financial loss in the short-term insurance industry because of an excess. And excesses can vary dramatically from insurer to insurer, even from product to product with a insurer. So always make certain what your excess is and plan according to that. It's fine saying, oh, I've saved 300 Rand on my car insurance, but in the event that I have a claim, I now need to pay an additional 10 or 15,000 rand as an excess towards my portion of the loss. Whereby paying 300 rand extra can dramatically reduce your excess amount.
Yeah.
And again, it gets down to planning and sitting down with somebody who understands these things, who can do a proper analysis for you so you can understand what would happen in the event of a claim. If you're in a situation where you have access to additional funds, where you know I can cover this excess, then by all means take a higher excess, save premiums on a monthly basis, use those savings and build up towards investing in yourself.
Yeah. And then you can start self-insuring.
Yes.
Over time, because you can build your own little security for excesses, increase your excesses, pay less premiums. Jaapie, if you just want to give people your contact details, if they need to get in contact with you, want to discuss anything, have any questions, where can they get hold of you?
Lawrence, probably the easiest would be to contact me on WhatsApp on my cell phone number 081 383 7256, or else they can email me jaapie@retirehappy.co.za.
And a lot of people jump onto direct insurers specifically for this, and that is the cashbacks. They're going to give you 20% of your premiums back in 5 years. Is it something that people need to look at? Is it really as beneficial as the marketing guys make it out to be? Or is it a whole lot of bullshit baffles brains?
Lawrence, that's always an interesting question to answer. And I think to understand the impact of a cashback, we have to understand the internal structure of what happens and how people claim. So there's basically in the financial planning and short-term insurance industry 2 ways of looking at this. Number one, your traditional cashback. For those of you who don't understand how this works, like you pointed out, you pay a premium for a set amount of time. If you do not claim during that period of time, you will get a percentage of the premiums you paid back as a cashback bonus. I'll go into a little bit more detail now, but let's understand the concepts first. The second one is what they call in the industry a no-claim bonus. No-claim bonus starts at 0 and usually moves up to around 7. What this means is for every year you are insured with a company, you get a reduction in your premium if you do not claim on that specific section of the insurance policy. And that's a very big difference to understand, because you earn no-claim bonuses on every section. So you get a no-claim bonus on your household contents, on your building, on your vehicle, and so on and so forth. Yeah. Whereas your cashback focuses on your whole policy. They don't separate it out into little different sections. So if you have a minor vehicle accident and you claim, there goes your cashback bonus. Whereby if you have a minor accident with your vehicle and you claim, yes, you do not earn a no-claim bonus, but you still earn a no-claim bonus on the other sections of the policy. So let's understand how and why.
Sorry, I'm interrupting you, but obviously, so what that means is they've basically replaced no-claim bonuses with cashback bonuses.
Yes.
And it's that whole thing of people seeing it as a big benefit because they're getting it all at once instead of getting the benefit on a monthly basis.
Yes. That is the main thing. I mean, people always like a little present and a little surprise. So it's sold on the basis that, in 5 years' time, if we use an average, I will get some of the premiums I paid back. Now, let's analyze this. First off, whenever you apply for a product which has a cashback bonus, you will notice that a portion of your premium is allocated to fund the cashback. In some instances, it's up to 15% of your premium goes towards funding your cashback.
Yeah.
So now you're paying extra, so you can get some premiums back after a 5-year period. Remember, guys, you get a portion of your premium paid back with no growth. So if you're paying 1,000 Rand on a monthly basis, you will get after a 5-year term 20% of your premiums paid back in cash, so you'll get 1,000 Rand back in cash. If you take 200 Rand and put that in an investment for a 5-year period, you'll have more than 1,000 Rand.
You'll have growth on it. And also what happens a lot is that people now don't claim for things, like a windscreen, for example. They don't claim for the windscreen, they'd rather pay for it from their own pocket because they don't want to lose their cash back.
That's a very, very important thing. Yes, the rules regarding cashback bonuses have been relaxed a lot. A big reason for this was pushback from clients saying, but listen, if I now have a windscreen claim, for instance, now I lose my cash back. So yes, that has been relaxed a little overall. Please still refer to your policy wording and terms and conditions because it differs wildly from company to company. What we also have to understand about cashbacks is, in the event that you do claim, not only will you lose your cashback and you have an excess, it can also have a negative impact on your underwriting in future. With a no claim bonus, it builds up. It shows that, listen, this client is not a repeat claimer, and it's analyzed every year. So the benefit for you as a person is much bigger than, oh, yeah, I've got a cash back from an insurance company, which you paid for in any case.
Yeah, at the end of the day, it is your own money that they just give back to you. I would rather pay 200 Rand a month less than get 200 Rand a month after 5 years, and rather spend that money more optimally for me. And that's also where our coaching comes in, where we teach people what to do with that money, because I think one of the big reasons the cashback is beneficial, and I use air quotes for those of you on radio that can't see me, beneficial, is the fact that if most people, if they don't get it as a lump sum at the end of 5 years, that money would be spent on trivialities and they won't lose it in any case. Where with our coaching model, whatever the guy saves goes into work for him, whether it is settling debt, whether it is building security, etc., etc. So you have to give every Rand a job. So it's pointless to go from one insurance company to another insurance company. I see the adverts so often. I saved 700 Rand a month. And then I always think, but what are you doing with that 700 Rand? Next month, does it actually make a difference in your life that you've now saved 700 Rand on your insurance? Most people, I would say more than 90%, makes no difference. 3 months later, their life is exactly the same as it was when he was paying the 700. So it's all about really having control of your cash flow as well.
That's so true, Lawrence. And again, it gets back to having a proper financial advisor looking after your affairs.
Yeah.
It's not about selling insurance.
There's one last thing, and I don't want. We have to get to the different sections, but there's one last thing that a lot of people have concerns about, and this is this drive or this move that insurance companies had into tracking driver behavior. So they put a little thingy in your car, and this thing can see when you brake hard, when you go over speed, and the effect of that. Because a lot of people are afraid that, firstly, the selling point there is they say that, well, if you have good driver behavior, you can reduce your premiums. The negative that people are concerned about is, yeah, but now I drive 124 in a 120 zone, get into an accident, and then the insurance company uses that information to repudiate claims. What is there reason for people to be concerned about that, or is it not really something that they need to be concerned about?
Lawrence, there's two ways of looking at it. The first and most important thing is we've got rules and legislation in South Africa and all across the world governing driver behavior. If the speed limit is 120, you are supposed to drive 120. You're not supposed to take corners, 90-degree corners at 80 kilometers an hour. You're not supposed to barrel down on a stop street and then slam on the brakes. I know you want to be a racing driver. Unfortunately, you are not.
Yeah.
That's
Especially
why,
after you've watched the Formula One on a Sunday.
Yeah, with a couple of brandies. So, guys, realize there is legislation. What the whole tracking device thing has brought to light is it's actually made drivers more conscious of how they're driving. which isn't a bad thing. Because now they are conscious of the fact that somebody else is looking at how they're driving, and it could influence their premiums, it could influence their claim payout going forward. So that's the pro of it. The con of it is, yes, definitely, the information gathered there could result in a claim being repudiated. But the claim would have been repudiated in any case if you broke the law while you were busy driving, driving under the influence, over or exceeding the speed limit. That's against the law, guys. If the insurance company could prove that earlier, they would have repudiated the claim in any case. So the bad side is that now these people know exactly what I'm doing in my car. The good side is now there's somebody who knows exactly what I'm doing in my car.
And I am more aware of it as
well.
And
I am more aware of it. Now I am looking at not speeding. We have to also realize, just on the whole speeding thing, is if the speed limit is 120 kilometers an hour, they are not going to repudiate your claim because you drove 124. Okay, they are looking at excessive speeding.
Also, I think people need to understand the difference between a traffic violation and a criminal violation.
Yes.
So the standard exclusion, if I understand it correctly on a policy, is if you are busy with any criminal activity or in a criminal,
yes, correct,
then it is immediate repudiation.
Yeah.
But not necessarily traffic violations.
No.
It's not a direct repudiation.
No.
But again, if you were driving 225 in a 120 zone with your Audi TT and you write it off and they can prove it, you're going to have problems. You're going to have an issue getting the claim paid out.
It would have been an issue in any case.
Exactly.
Because that's why insurance companies have assessors. They will go out, they will investigate it. And driving 220 in 120 zone is no longer a traffic offence.
Then it becomes a criminal offence.
Then it becomes reckless and negligent driving.
Yes. Yeah. Okay, so we've got another message from Warren. It says, one of my financial mentors taught me that one should never insure anything that they cannot afford to replace. Things like motor, third party or liability should be insured, but the premiums are extremely low. When I say afford, it means have the actual cash reserves or sums insured built into your reserve fund. Doing this, if you never claim, you retain the money. It forces you to have the reserve. You never have to worry about an excess, whereas your vehicle sum insured reduces whilst your premium increases. In the scenario above, your lump sum grows, where you're basically insuring something that reduces in value. Yeah, I think that comes into the whole discussion we have regarding slowly but surely self-insuring yourself, even if it's just having a excess and then increasing the excess over time. And then also, if you can get to a point where you have enough money in your reserve account to pay for a specific thing, then you don't have to insure it anymore.
Definitely. What we have to understand is three key concepts. First off, we've mentioned numerous times self-insurance. Let's just understand what self-insurance is. Self-insurance is you becoming your own insurance company. So instead of paying an insurance company a monthly premium, you take that premium and you put it into a type of savings account. The problem is most people don't have the discipline to realize that money is to replace my cell phone or my laptop or whatever the case might be. So it needs to be kept separate from all your other financial planning, because this would then be a true emergency type of account. Secondly, we have to realize it takes time. Very few people on this planet have enough funds available to go, oh, right, I'll just transfer 20,000 Rand over and now that's done. I'll go on with my life. So it's an account we need to build up over time by making use of practical and educated financial education.
Yes.
Having somebody help us and mentor us and monitor it for us. The last and most important thing, there are just some things that you will almost never be able to self-insure. The average house in South Africa looking at the middle class, is around about 1.2 to 1.5 million.
And to replace and rebuild is more. It's like 2 million, 2.5
Very
million.
much so.
Because people don't take into account, and we'll get to that thing has to be broken down first. Everything has to be taken away, then rebuilt. They just think, well, to build this house is going to cost me 1.5. It's not. There's a lot of other work that needs to be done.
Very, very true. So there are unfortunately some things we will always need to have insurance for. Probably the most important one would be liability, because liability insurance can run into the millions.
Yeah, and I think here's the big thing, is having that capital sitting there idle for things like a house. Let's say the house is insured for 2 million rand. Let's say you could put 2 million into account and say, that is me self-insuring my house. Now the money is basically sitting there idle, waiting for you to claim your house. That money, if that money is allocated and used to invest in some kind of an investment, you could probably earn 3 or 4 or 5 or even 10 times monthly the income that it is costing you to insure that amount. So you must look at what is the capital worth if it sits in an account against what it could generate for me if I put it towards an investment or something like that. Because your house might be 700 Rand a month, but if you take that 2 million, you invest it in a business asset or a fixed asset, you could generate 4,000 or 5,000 Rand a month from that. Then it's not worth it anymore. So it's sort of now I've got this picture in my head of a graph of at some point it will reach each other where it's not worth anymore having the capital on hand and saving the premiums that you're paying.
That's so true, Lawrence. Do yourself a favor, all our listeners out there, go and look at, and let's stick with your building for now. Go and look at what is the insured amount of your building and what's the premium, and then divide the insured amount by the premium. Risk cover is normally geared towards it being physically impossible for you to pay in premiums more money than you would get out in the event of a total loss. Okay, so yes, we reach a point where those two lines converge, where it's cheaper to actually pay for insurance
monthly, than
and
use
invest
the capital.
the capital in some form of income generating asset, than saying, I'll have this capital in reserve. The problem is, guys, if we have this capital in reserve, it needs to be true capital in reserve. We can't have it tied up in an asset, because if your house burns down, you need access to that capital, and you need it quite soon.
Yeah, you can't wait 8 months for the property, say for example,
to be sold, or whatever the case might be.
Yeah, so Warren comments, he says, agrees with your points. Maybe looking more towards the expensive insurance types like credit risk, all risk, motor, watercraft. Exactly that, Warren. You're getting the point exactly. It is those things like your cell phone, for example.
Yeah.
You could replace your cell phone for a second hand or a whatever for the same cell phone you had for say 7 grand. Now you're paying 150 Rand a month for that. To have 7,000 Rand in reserve and save that 150 is worth it. But getting to stuff like property and cars to a large extent where it's huge amounts, then you don't always want to have that capital sitting there idly waiting for you to have a claim. Let's get into the sections. What are the different kinds of things that you can insure on short-term insurance and that you should insure, and what you need to look out for?
Lawrence, there are a lot of different sections under short-term insurance, but I feel we should focus on the main 5, which most people will either need to insure or already have insured on their policies. Those 5 being your household contents, your all risk cover, your building or home owner's insurance, your vehicle, and then the various liability sections. There's a lot of content to discuss under each of these sections, and like you pointed out, I think we should see how far we get today and maybe continue this conversation at a little later stage. So let's start off household contents. First off, what is household contents? The easiest way to understand household contents is everything you take with you the day that you move. If you are able to lift up the building, turn it upside down. Everything that falls out, that is household contents.
Yes.
Now, guys, I know that's why I gave the two examples. Some people, when they move, take the light switches and the light sockets.
Especially if they are tenants.
That's not your household
Take
contents.
the geezer with.
Yes, unfortunately. It's harsh growing up in a mining community. But in any case, so household contents. Everything you take with you the day that you move. Now, we have to tie this back to what we mentioned earlier, especially average and new for old. Remember, the question we need to ask ourselves is, what is it going to cost me to replace everything in my house in the event of a total loss? Total loss being defined as the house burning it down, the house washing away, the house being swallowed by the earth in the event of an earthquake.
Yeah, and this is something that people need to really get their heads around. So I wanna reiterate that it is everything, not the big things, not the furniture, not the electronics. It is everything. Even your underwear that you wear for your husband, there at the back of your the shelf that's hidden away from everybody, that's part of everything. You need to look at everything in your house needs to be valued and insured.
That is so true, Lawrence. And you know, it's very, very hard to. People always ask, so what do you think I should insure my household contents for? I don't know. I don't stay in your house, and I'm not going to scratch through your drawers to see what's hidden there. But here's a couple of practical guidelines. The average woman's closet is worth around 80,000 Rand. The average men's closet worth around about 60,000.
Just I would have guessed like 20. Because women is like 4 times more expensive. But okay.
The modern man, Lawrence,
Yeah,
the modern man.
Yeah.
Average kids, we're talking about up until about teenagers, worth around 40,000. So if you are a household of mom, dad, and 2 kids, we're already looking at almost 200,000 Rands worth of household contents just in clothes. Then we haven't gotten to the high-end electronics. We haven't gotten to the cutlery and crockery. Again, looking at averages on those things, we're looking cutlery, crockery, linen, all of those things, on average 75 to 100,000. Now, guys, I know this all of a sudden starts adding up, but again, we're referring to on average for a middle class household.
And that doesn't include the clothing, doesn't include all the jewelry. As
Definitely.
Well. So that is also have to be added. And again, modern man, there's more and more watches, there's more and more these kind of things that men wear that you have to add onto it as well. It really ramps up. And guys, it's so easy to blame the insurance companies for implementing average. And they don't want to pay us out. To be 100% honest, I think that most of the times the insurance companies are extremely lenient when it comes to average.
They are.
And if they really wanted to, I would say more than 90% of claims they would have been able to implement average on their claims if they really, really wanted to. Because I think there's very, very few people that are actually correctly insured on their household goods.
Like you say, Lawrence, and it unfortunately results in this vicious circle, not just with household contents insurance, with all insurance, but very specifically with household contents insurance, where as soon as people have a claim, they have a burglary. The TV and the toaster and the hi-fi was stolen. People still have hi-fis, but in any case, sound system was stolen. So when they have this claim, they know, according to them, the insurance company is going to try and pay out less. So what do? They inflate the claim. All of a sudden, oh no, but I had a bigger TV, I had a better sound system. Oh, it's not just the toaster, it's also the kettle that was stolen and the microwave. So now the claim is inflated. Because of this, there's an excess. That's the reason we have excesses when people claim. that is the reason why there's average to be applied. Because the insurance company realizes that people are inflating claims and claiming for things they don't even have.
Yeah.
So somewhere they need to recoup money. They need to minimize their own losses. We have to remember, an insurance company is still a business. It's still in the business of making money for its shareholders. Yes, by being correctly insured, you can minimize your financial loss. By planning correctly, you can minimize your financial loss. Because the idea behind insurance is always to place you as near as to the situation you were before the actual loss. So understand it. Again, it gets down to having a proper financial advisor. It's fine under insuring your household contents, but understand the implications. Then know that, listen, if I have a complete loss, they're only going to pay out the insured amount, and I'll have to replace everything in my house with that. Or if I have a loss, a burglary, a small little fire, they are only going to pay out a portion of my claim. And if you're fine with that, if you've got a reserve account, if you are able to take that financial blow, then yes, by all means. But it all comes down to understanding what you're insuring, what you're paying for, and what is the actual impact when you claim.
Yes. Yeah, it's so important. I've got a quick question here. Is my garden furniture on my patio and all the tools in my garage shed insured under my household contents?
It is. Short answer.
Yeah.
Is it something you are going to take with you the day that you move, that you leave? Yes, it is. So it's also insured. Sure. A couple of things under household contents we have, or a few people realize. So your household contents is not just the things in your house. It is also your lawnmower. It is also your patio furniture. It's also a lot of times things you take with you on a day-to-day basis, or not necessarily a day-to-day basis, because
every now and again,
because your jewelry could be covered under household contents. Your clothes when you go on vacation could be covered under household contents. If you go and visit your friends and you take your PlayStation along, it could be covered under household contents, because there's a section that details specifically contents temporarily outside of the home. So basically, household contents, everything in your yard that you take with you the day that you leave.
Yeah. So home meaning everything where you stay, basically.
Correct.
Garage, everything. And again, that comes back to how much you have to insure your house for, because we've gone through these values very quickly, and then we take people's these tools, spanners, screwdrivers, all of those kind of things. It actually becomes almost ridiculous.
And that's why you rightly pointed out, Lawrence, as well, that if an insurance company really wanted to apply average, they can seriously pay out only fractions of claims.
Yeah.
Because rarely, if ever, would a assessor go into the garage and look at the tools and take the patio furniture into account.
Yeah.
And they generally just have a quick little look around, and from there extrapolate.
Get an estimate. They will never, or very seldom would they come and do a full inventory to make sure that the values are when you have a claim. But they have the experience to walk in, look at the lifestyle, and have an idea of how much the goods should be.
That's so very true. And a lot of times people think assessors are idiots and out to screw them. No, they are not. An assessor serves two purposes. Number one, making certain that you are paid out. That was a difficult word. Paid out for what you're actually claiming for. But also, secondly, that the insurance company is actually only paying out for things that are insured. Guys, this brings us back on to my last point concerning cashbacks. And I think that the last word on the show. Insurance companies are not stupid. They've got some very, very, very smart people sitting there. That is why they keep on changing products. That's why they bring out innovative new paybacks and ways of structuring it. Because they know and they've got the data to know how many people are going to be claiming for a certain event. In the old days, you even had varying insurance premiums for different color cars, because they did a study and various studies to say that, oh, this color car is in more accidents than the other color cars. So those people are called actuaries. And if you really want to hate somebody, hate actuaries.
Yeah.
They are the guys who determine premiums. They are the guys who say, oh, we can afford to do a cashback payment because, again, on average, 86% of people claim within 5 years of taking out insurance.
Yeah.
There goes your cashback bonus.
Yeah. And here's the thing with what clients, and it is unfortunately, we think these things won't happen, and then when it happens, we don't get what we expect we were going to get, and then it's always somebody else's fault. But this is something that people need to keep in mind. Is there are certain exclusions on your policy, there are certain excesses. It's all to minimize the risk of the insurance company so that they can keep premiums affordable. So now what happens is a person puts in a claim, they have an excess, or they have a certain exclusion, so some of the claim aren't paid out, or whatever the case may be. Then they're upset. I pay my premiums, the insurance company always looks for an excuse not to pay my claim. What people need to keep in mind is, if the insurance company had to insure all of that risk, the premium would have been dramatically more expensive, which means that same client would probably not have taken out that insurance in the first place, which means he wouldn't have had a claim at all. Now at least he has a claim because it was affordable enough. So there's a fine line between insurance companies having to pay out everything and premiums having to be affordable. And it comes down to what happened with medical aids. In the 80s, they had medical aids that covered everything. It was all the medical aids was this old traditional medical aids. Then the government came and said, but not enough people have access to medical aids because they underwrite people that are sick, they penalize people that are older, etc., etc. So take all of that away, because we can't discriminate against people because of their age and because of their illnesses and whatever. So what happened is medical aids had to become much more expensive, and now less people have access to private medical aid than they had in the 80s. So it's a very fine line. You can't play around with it and not have a ripple effect of it.
That's very, very true. Lawrence, if we continue this conversation, we're going to be here till tomorrow. I think we've covered household contents to a large extent. Guys, again, please feel free to contact me, to contact the Retire Rich and Happy offices, and we will gladly assist you.
Yeah.
Final word from my side: it's not about what you insure. It's about understanding what you're insuring.
Yeah, that is. If you look at our slogan in our business, it is from hope to certainty. Because even with short-term insurance, there's way too much hope happening. People hope that if something happens, the insurance company will pay them out. Rather understand what you are covered for and what you are not covered for, so that you can have the certainty that if something happens, oh, this is going to be my excess. Don't address it when it actually happened and then you're in trouble. Hi guys, Lawrence here. Thanks for watching this video. I hope you found it informative and you got some benefit out of it. Please add in the comments any questions you might have or any other topics that you would like me to talk about. Please subscribe to our channel, hit the bell button so that you can get notified of any new videos that we post so you don't miss anything. Thanks guys, see you around.